Gold just did something it hasn't done in over 4 decades. And if you're not paying attention, you're about to miss the biggest wealth transfer opportunity of your lifetime. I'm not talking about a typical bull market rally. I'm talking about a fundamental restructuring of the global monetary system that's happening right now, in real time, while most people are completely asleep at the wheel. Let me show you what's really going on. Right now, gold is trading above $4,000 per ounce. That's not just a new all-time high, that's a 60% gain in a single year, the best annual performance since 1979. And here's what nobody's telling you. This isn't the top. This is just the beginning of a historic revaluation that could send gold to levels most people think are impossible. But before I explain where this is headed, you need to understand what's driving this move, because it's not what you think. Most people look at gold and they see a commodity. They see something that goes up when people are scared and goes down when things calm down. That's the surface level understanding, and it's completely wrong. What's happening right now is a complete restructuring of how the world stores value, and it's being driven by the largest, most sophisticated financial institutions on the planet. Central banks are buying gold at a pace we've never seen before, not just buying it, hoarding it, stockpiling it like their survival depends on it, because it does. In the past 3 years, central banks have purchased more gold than at any point in recorded history. We're talking about thousands of tons. Countries that have never been major gold buyers are suddenly accumulating massive positions. China, Russia, India, Turkey, Poland, even countries you wouldn't expect. And here's the critical part. They're not buying gold because they think it's going to go up 10% or 20%. They're buying gold because they're preparing for a world where the dollar is no longer the dominant reserve currency. Let me paint you a picture of what that means. For the past 50 years, since Nixon closed the gold window in 1971, the entire global financial system has been built on one foundation, the US dollar. Every country needs dollars to buy oil, to settle international trade, to hold as reserves. The dollar has been the ultimate store of value, the ultimate medium of exchange, the ultimate unit of account. But that system is breaking down, and it's breaking down fast. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternative payment systems that bypass the dollar entirely. They're settling trade in their own currencies, they're building new financial infrastructure, and they're backing it with gold. This isn't conspiracy theory, this is documented fact. These countries have openly stated their intention to reduce dollar dependence, and they're putting their money where their mouth is. Russia has been one of the most aggressive accumulators. After Western sanctions cut them off from the dollar system, they went all in on gold. They've been buying thousands of tons, building their reserves to levels not seen since the Soviet era. China has been even more strategic. They've been accumulating gold quietly, consistently, for over a decade. Official numbers show they hold around 2,000 tons, but analysts believe the real number could be 3 or 4 times higher. China doesn't report all their purchases. They buy through back channels, through state-owned banks, through Hong Kong. Why would they hide their purchases? Because they don't want to drive the price up before they're finished accumulating. They're playing the long game, building a position that will give them leverage when the dollar system finally cracks. And it's not just emerging markets. Even traditional Western allies are diversifying away from dollars. Germany repatriated hundreds of tons of gold from New York and Paris. They wanted it on home soil, under their control. That tells you something about their confidence in the current system. Poland has been buying aggressively. Hungary has been buying. Singapore has been buying. These aren't countries on the fringe. These are sophisticated, stable economies making a calculated bet that gold is going to be more valuable than dollars in the years ahead. Now, here's where this gets really interesting. The amount of gold that exists in the world is finite. All the gold ever mined in human history would fit in a cube about 70 feet on each side. That's it. That's all the gold that exists above ground. And most of that gold is already owned. It's in jewelry. It's in central bank vaults. It's in private hands. The amount of gold available for purchase is actually quite small. But the demand is exploding, not just from central banks, from institutional investors, from sovereign wealth funds, from family offices managing billions of dollars. These aren't retail investors buying a few coins. These are massive institutions trying to acquire thousands of ounces, tens of thousands of ounces. And there's not enough physical gold to satisfy that demand at current prices. That's what creates a revaluation. When demand massively outstrips supply, price has to adjust. It's not a matter of if, it's a matter of when and how much. Let me give you some context on what a revaluation actually looks like. In 1971, when Nixon closed the gold window, gold was fixed at $35 per ounce. Within a decade, it hit $850. That's a 24x increase, a complete revaluation of gold's value relative to the dollar. Why did that happen? Because the world realized that dollars were being printed faster than gold could be mined. The supply of dollars was exploding while the supply of gold remained relatively fixed. So gold's price had to adjust to reflect that reality. We're in a similar situation now. Actually, it's worse. Since 2020, the U.S. has printed more dollars than in the entire previous history of the country combined. The money supply has exploded. The national debt has exploded. And there's no end in sight. Meanwhile, gold production has been flat, actually declining in some years. The easy gold has already been mined. New discoveries are rare. Production costs are rising. The supply side is constrained while the demand side is accelerating. That's the setup for a historic revaluation. Now, some people will say, but gold doesn't pay interest. It doesn't generate cash flow. Why would institutions want to hold it? That's the wrong question. The right question is, what happens when you lose faith in the currency that's supposed to pay you interest? If you're holding bonds denominated in a currency that's losing purchasing power faster than the interest rate you're earning, you're not making money. You're losing money. The nominal return is positive, but the real return is negative. That's the situation we're in now. Real interest rates adjusted for inflation, have been negative for years. That means holding dollars, even in interest-bearing accounts, is a losing proposition. Gold doesn't pay interest, but it also doesn't lose value through inflation. It maintains purchasing power over time. That's its function. That's why central banks hold it. That's why sophisticated investors are accumulating it. And here's something most people don't understand about gold. It's not just a hedge against inflation. It's a hedge against systemic risk, against the possibility that the entire financial system could experience a major disruption. Think about what happened in 2008. The global financial system nearly collapsed. Banks were failing. Credit markets froze. The Federal Reserve had to create trillions of dollars out of thin air just to keep the system functioning. Gold went from $800 to $1,900 in the aftermath, not because of inflation, because of fear. Fear that the system itself was unstable. Fear that paper assets might not be worth what people thought they were worth. We're facing similar risks now, actually bigger risks. The debt levels are higher. The imbalances are larger. The potential for disruption is greater. And the smart money knows it. That's why they're buying gold. Not as a speculation, as insurance, as a core holding that will protect wealth no matter what happens to the financial system. Quick aside here, if you're sitting on a significant retirement account, $100,000 or more, you might want to look into how gold IRAs work. I put together a free guide that covers the mechanics, how to get physical gold into your retirement account without triggering taxes or penalties. It's in the description if that's relevant to your situation. Worth understanding your options. Anyway, back to where this price is headed. The technical picture on gold is extraordinary. We've broken out of a multi-year consolidation pattern. We've taken out every major resistance level. We're in uncharted territory with no overhead supply. When you look at the chart, what you see is a market that's just beginning a major uptrend. The kind of uptrend that can last for years. The kind that can multiply your wealth several times over if you position correctly. But the technical picture is just confirmation of the fundamental story. And the fundamental story is about a global monetary system in transition. Here's what most people don't realize. The dollar's dominance isn't natural. It's not based on some inherent superiority of the U.S. economy. It's based on a specific set of arrangements that were put in place after World War II. The Bretton Woods system made the dollar the world's reserve currency, but that system was backed by gold. Every dollar was supposed to be redeemable for gold at a fixed rate. That's what gave the dollar its credibility. When Nixon ended that convertibility in 1971, the dollar became a pure fiat currency. Its value was based entirely on faith. Faith in the U.S. government, faith in the Federal Reserve, faith that the dollar would maintain its purchasing power. For 50 years, that faith held. The dollar remained dominant. But faith is a fragile thing, and right now, that faith is eroding. Countries around the world are watching the U.S. weaponize the dollar, using sanctions, freezing assets, cutting countries off from the SWIFT payment system. And they're realizing that holding dollars makes them vulnerable, that their reserves could be frozen or seized at any moment for political reasons. That's why they're diversifying into gold. Gold can't be frozen. It can't be sanctioned. It can't be printed. It's the ultimate neutral reserve asset. And as more countries make this shift, it creates a self-reinforcing cycle. The more countries that move away from dollars and into gold, the more pressure it puts on the dollar, which makes other countries more nervous, which makes them want to diversify, which puts more pressure on the dollar. This is the dynamic that's unfolding right now. And it's accelerating. Look at what's happening in the oil markets. For decades, oil has been priced exclusively in dollars. The petrodollar system was the foundation of dollar dominance. If you wanted to buy oil, you needed dollars. That created constant demand for dollars from every country in the world. But that's changing. Saudi Arabia is now accepting yuan for oil sales to China. Russia is selling oil in rubles and yuan. Other producers are exploring alternative currencies. The petrodollar system is breaking down. What does that mean for the dollar? It means less demand, less need for countries to hold large dollar reserves, which means more of those dollars coming back to the U.S., which means inflation, which means loss of purchasing power. And what does that mean for gold? It means gold becomes more valuable relative to dollars, because gold is the alternative. Gold is what you hold when you don't trust fiat currencies. Now, let me address something that skeptics always bring up. But governments could just confiscate gold like they did in 1933. First of all, that was a different era. The U.S. was on a gold standard. The government needed gold to back the currency. That's not the case anymore. There's no economic reason for confiscation. Second, the world is different now. Capital is mobile. Wealth is global. If the U.S. tried to confiscate gold, wealthy individuals would simply move their assets to other jurisdictions. It would be counterproductive. Third, and most importantly, the trend is moving in the opposite direction. Countries are accumulating gold, not confiscating it. They're recognizing its value as a reserve asset. They're building their positions, not trying to suppress them. The confiscation argument is a red herring. It's based on fear, not on current reality. Here's what you need to understand about the current moment. We're at an inflection point, a turning point in the global monetary system that happens maybe once or twice in a century. The last major inflection point was 1971. Gold went from $35 to $850 over the next decade. That's the kind of move we could be looking at now, except the starting point is higher and the imbalances are larger. If gold were to experience a similar percentage move from current levels, we'd be looking at prices well above $10,000 per ounce. Some analysts are calling for $15,000. Some are calling for $20,000. Are those numbers realistic? Let's look at the math. The total value of all above-ground gold is currently around $17 trillion. That sounds like a lot, but compare it to the total value of global financial assets, stocks, bonds, real estate, derivatives. We're talking about hundreds of trillions of dollars. If just a small percentage of that capital shifts into gold, the price impact would be enormous. If global investors decided to hold 5% of their wealth in gold instead of 2%, that would require trillions of dollars of buying, and there's not enough gold available to satisfy that demand at current prices. The price would have to rise, significantly, to ration the available supply and bring the market back into balance. That's not speculation, that's basic supply and demand economics. And here's the thing, we're already seeing the early stages of this shift. Gold ETFs are seeing massive inflows. Sovereign wealth funds are increasing their allocations. Family offices are building positions. The institutional demand is real and it's growing. But most retail investors are still on the sidelines. They're still thinking of gold as a barbarous relic, as something their grandfather owned. They don't understand that gold is being remonetized, that it's becoming a core component of the new global financial system. The people who understand this early, who position themselves before the crowd figures it out, are going to do extraordinarily well. The people who wait until gold is at $8,000 or $10,000 and everyone's talking about it, they'll still make money, but they'll have missed the biggest part of the move. Let me tell you a story that illustrates this point. In the late 1990s, gold was trading around $250 per ounce. It had been in a bear market for 2 decades. Nobody wanted it. Central banks were selling it. Investors thought it was dead money. But a small group of contrarian investors saw something different. They saw that gold was undervalued relative to the money supply. They saw that the tech bubble was unsustainable. They saw that the financial system was becoming increasingly unstable. So they bought gold. Not because it was popular, because it was cheap and the fundamentals were compelling. Over the next decade, gold went from $250 to $1,900. Those early investors made 7x their money. The people who bought at $250 did far better than the people who bought at $1,000, even though both groups made money. We're in a similar situation now. Gold has already moved significantly. But relative to where it's going, we're still early. The revaluation is just beginning. The difference between now and the late 1990s is that the imbalances are much larger. The debt levels are much higher. The geopolitical tensions are much greater. The potential for systemic disruption is much more severe. That means the magnitude of the move could be much larger. We're not talking about gold going from $250 to $1,900. We're talking about gold potentially going from $4,000 to $15,000 or $20,000. And the timeline could be compressed. In the 1970s, the big move took a decade. This time, it could happen much faster. Because information moves faster. Because capital moves faster. Because the world is more interconnected and more unstable. When the crowd finally wakes up to what's happening, when the mainstream media starts covering the dollar crisis and the gold revaluation, the move could be explosive. We could see gold rise $1,000 in a matter of months, maybe weeks. That's not hyperbole. That's what happens in markets when a major paradigm shift occurs. The price action becomes nonlinear. It accelerates. It goes vertical. And if you're not positioned before that happens, you'll be chasing. You'll be buying at much higher prices. You'll be competing with millions of other investors who suddenly want the same thing. Now, I want to address something important. This isn't about fear. This isn't about predicting doom and gloom. This is about recognizing reality and positioning accordingly. The global monetary system is changing. That's not a prediction. That's an observable fact. Central banks are buying gold at record levels. Countries are reducing dollar dependence. Alternative payment systems are being built. These are things that are happening right now. The question isn't whether the system is changing. The question is, are you positioned for that change? Most people aren't. Most people have their wealth entirely in paper assets. Stocks, bonds, cash. Assets that are denominated in currencies that are being debased. Assets that are vulnerable to systemic risk. Gold is different. Gold is real. Gold is tangible. Gold has maintained its value for thousands of years across every civilization, every empire, every monetary system. When the Roman Empire collapsed, gold retained its value. When the British pound lost its status as the world's reserve currency, gold retained its value. When the Weimar Republic experienced hyperinflation, gold retained its value. Gold is the constant. Currencies come and go. Empires rise and fall. But gold endures. That's not romanticism. That's historical fact. And it's why sophisticated investors, the people who have preserved wealth across generations, always maintain a significant allocation to gold. They understand that gold isn't about making a quick profit. It's about preserving purchasing power, about maintaining optionality, about having an asset that will hold value no matter what happens to the financial system. And right now, At this particular moment in history, gold is also offering the potential for significant appreciation because we're at the beginning of a revaluation, because the fundamentals are more compelling than they've been in decades. Let me give you another historical parallel that's relevant here. In 1980, gold peaked at $850 per ounce. Then it entered a 20-year bear market. By 2000, it was trading at $250, a 70% decline. Most people gave up on gold. They thought it was finished. But in 2001, something changed. Gold bottomed and began a new bull market. Over the next 11 years, it rose from $250 to $1,900, a 7x increase. What changed? The fundamentals changed. The Federal Reserve started cutting interest rates aggressively. The government started running large deficits. The dollar started losing value, and investors started recognizing that gold was undervalued. We're in a similar situation now, except the fundamentals are even more compelling. Interest rates have been near zero for years. Deficits are exploding. The money supply has grown exponentially. And now, on top of all that, we have geopolitical tensions and a fracturing of the global monetary system. The setup for a major gold bull market is better now than it was in 2001. And that bull market produced a 7x return. This one could be even larger. But here's the critical point. You have to be positioned before the move happens. Once gold is at $8,000 or $10,000 and everyone's talking about it, the easy money has been made. The time to act is when the fundamentals are compelling, but the crowd hasn't figured it out yet. That's where we are now. Gold has already moved significantly, but most people still don't own any. Most financial advisors still recommend only a small allocation, if any. Most investors are still focused on stocks and bonds and crypto. That's the opportunity. The gap between what's happening and what people perceive is happening. That gap is where fortunes are made. Now, let me talk about the mechanics of how this revaluation could unfold. There are two ways gold could reach much higher prices. The first is gradual, a steady, sustained bull market that takes years to play out. Gold slowly grinding higher as more investors recognize the value and accumulate positions. The second is sudden, a crisis event that causes a rush into gold. A currency crisis, a banking crisis, a geopolitical shock. Something that makes people suddenly realize that their paper assets aren't as safe as they thought. Both scenarios are possible, and honestly, we could see a combination of both. A gradual rise punctuated by sharp spikes during periods of stress. What's important is that you're positioned for either scenario. Because if you wait for the crisis to happen before you buy gold, you'll be buying at much higher prices. The time to buy insurance is before the fire, not after. And make no mistake, gold is insurance. It's insurance against currency debasement, against systemic risk, against the possibility that the financial system could experience major disruption. But it's also more than insurance. It's a strategic asset that's being revalued in real time, an asset that could multiply your wealth several times over in the years ahead. The people who understand this, who take action now, are going to look back on this moment as one of the best financial decisions they ever made. The people who hesitate, who wait for more confirmation, who need to see gold at $6,000 before they believe it's real, they're going to regret not acting sooner. This is one of those rare moments in financial markets where the opportunity is clear, the fundamentals are compelling, and the risk-reward is extraordinarily favorable. But the window won't stay open forever. As more investors wake up to what's happening, as more capital flows into gold, the price will rise. And the higher it goes, the less upside remains. The less attractive the risk-reward becomes. Right now, we're still early. Gold has moved, but it hasn't moved nearly as much as it's going to. The revaluation is just beginning. The big gains are still ahead. But you have to act. You have to take a position. Because this opportunity won't wait for you to feel comfortable. Markets don't work that way. The best opportunities always feel uncomfortable. They always require you to go against the crowd, to buy when others are skeptical, to act when others are hesitant. That's what separates successful investors from everyone else. The willingness to act on conviction even when it's not popular, even when the mainstream hasn't caught on yet. Gold is giving you that opportunity right now. A chance to position yourself for a historic revaluation, a chance to protect your wealth and potentially multiply it several times over. The question is, are you going to take it? Or are you going to look back in a few years and wish you had? The choice is yours. But the clock is ticking, and every day that passes, more investors are figuring this out. More capital is flowing into gold. The price is rising. The opportunity is shrinking. Don't let this moment pass you by. Don't be the person who understands what's happening, but fails to act. Because understanding without action is worthless. Gold is being revalued. The global monetary system is changing, and the people who position themselves correctly are going to do extraordinarily well. This is your moment. This is your opportunity. Don't miss it.